Well, greetings everyone and welcome to the July 2020 Investment Strategy Brief, which as ever this year, it's a COVID-19 update in so many ways. Now, when we look back to the start of the coronavirus crisis, we all talked about flattening the curve. It was all about trying to keep things under control, lessening activity, shutting things down, as much as anything to kind of help the healthcare system. And I think overall the country, in some ways the world, did a very good job of that. But now all of a sudden we're seeing some resurgence of the virus, and sort of monitoring that kind of thing becomes important again. And we're going to get into that. Here's an example of four graphs, three states in the U.S. overall, basically showing the pattern of what's going on. You've got New York, which we all know kind of hit early, actually sort of had some hospital type challenges, but then things have calmed down, and New York and sort of the tri-state area seem to be handling things reasonably well. But as we've seen in the news, et cetera, places like California, Texas, Florida, those are places where the virus is starting to emerge. And so things reopen. They've had to sort of slow that down and reverse those things a little bit. Again, I think the spirit of this is testing is going up. We all also know that the actual number of cases out there are well beyond those that have been sort of tested positive. And we're going to watch the data and watch the reopening. And again, we'll get into that. So as it relates to the reopening, I'll move super quickly through this, but recall that the federal government, basically the White House and CDC, offered some guidelines. It really comes down to 2-week intervals of improvement across a couple dimensions. And then when you see that and hospitals stay in check, you can kind of move to the next phase of reopening. And in their original sort of really simple framework, it was sort of a 3-phased approach. Think of it as 2-week intervals of improvement, move to the next phase. We all know that it's now much more complicated than that. Regions, states, counties, everybody's sort of doing a lot to very much fine-tune their reopening to try to keep the virus under control. And in fact, one thing that we've been doing is, looking across really the industry and to a variety of firms and sources for what we want to monitor, which really comes down to these sort of four concepts that need to be checked for reopening. Are cases declining? Is testing showing that things are getting better? Is hospitalization in check? And then to start with all of that, are symptoms being presented? And so there's different folks that are sort of monitoring this, and this is a chart that shows half the states, just to get them on a couple slides here. So for example, some states that are showing some trouble by this framework are Alabama, Georgia, and Texas. And so you can almost watch this day in and day out, and the states are going to move up and down as it relates to how many criteria they're satisfying. And then sort of on the flip side, the sort of second page is really, if you move down the page, improving in terms of what states are doing and how things are going. And so states like New Mexico, New Hampshire, Connecticut, Maine all seem to be in a decent spot. So again, think of it as we all know that the reopening has kind of been choppy, and people are worried about it, and they're trying to almost like micromanage it a little bit. And it's for good reason, because this is a tough virus, and we're all going to have to sort of manage our way through this. Now, one of the things we're trying to do, as was alluded on the first slide even, was to sort of buy ourselves time for medical research. So here's a sort of a quick update on what's going on there. Number one, we know that hundreds of companies are involved. Number two, there are companies that are very focused on studies and research for therapeutics, meaning you get the disease and what drugs can be made available to make things better. And there's been some movement on that and some good progress. But then also there are hundreds of companies that are focused on developing a vaccine. And here this chart kind of shows you how many there are, but also where they are in each stage. And you can see we have 4 that have moved to phase 3, kind of the final phase of testing. And that's all, in our judgment, going to be really accelerated with the goal of having an approved, sort of more publicly available vaccine by the end of the year, with a decent amount of production. But then 2021 is going to be the real focus in terms of producing those overall. So again, slowing the spread to buy time to see medical advance. So here's a chart that we introduced this month for this video. And basically, what I think is interesting, it's 6 different measures, you can dig into the individual numbers, but I think the more interesting thing is to look at the patterns. So we have retail and food service sales, unemployment, PMIs, consumer confidence, new home sales, and then ADP employment. And basically what you can see, of course, is that things were reasonably good up until the virus hit. Then things really got hit hard, and now they're improving. And so the spirit of this is almost to look at the shape of each of those graphs and recognize that we are starting to see evidence, and again, we'll get into this, that things got pretty bad in the second quarter, and yet now they're starting to improve. Now, one really interesting example of that is a specific metric called business new orders. So, my team called this a leading indicator of leading indicators. So it's sort of like a real look to the future. And basically what you can see here is that same pattern. Things were pretty good. They got hit hard as we made our way into the first quarter and sort of through the crisis, if you will, and now things are improving. So again, this is all about sort of a sort of surveys and what people think is going to happen, in this case as it relates to business new orders. And so bottom line is things are definitely improving. Now, another thing we're tracking, as we looked at last month, was basically mobility data. And here you can see parks, which not surprisingly are way up, residential, which is really staying home, which is reasonably up. Interestingly, grocery and pharmacy activities kind of getting back towards normal, which makes sense, right? We're all sort of routinely going to the store, getting what we need. And then, things that are still impacted, retail and recreation, not surprisingly, and then especially transit and transportation, and then workplace is still well below sort of normal levels. So again, what we're watching is, with all these different data sources, is sort of movement and where we're seeing it, and we're watching for improvement. And we've seen some improvement in recent months, but there are certain areas, again, like transportation and workplaces, where there's a long way to go. So this chart here is basically our chart that sort of profiles performance, looking back to 2019 and 2020 of the markets. Remember that last line in each table is the bond market, but the rest are basically equity indices. And this month we wanted to focus on something new to this table, which is the S&P 500 equal weighted index. So I think most would know that an index like the S&P is what's called cap weighted, meaning the bigger companies have a bigger weight in the index. Sort of think of it as their related to their value as it relates to the value of all the companies in the index overall. And so the net result of that is that larger companies influence the return of those cap-weighted indexes. So one way to sort of judge that is to look at an equal-weighted index where every company in the index has the same weight. And what you can see here, again, not surprisingly, is that year to date, basically, the equal weighted index is underperformed. What that's telling us is that the larger companies in the S&P have been the dominant drivers of the return. And so a lot of focus really across the industry is on how those companies are doing and whether there's going to be a reversal. And, hopefully in some ways it could be, get into this like some other things a little later. Basically, there can be a reversal where the rest of the companies in the index and the market more broadly kind of come back, especially on a relative basis. So we'll get into that. From a valuation perspective, here again is a chart we look at every month, and the story remains the same, that in the U.S., markets are pretty richly valued. It's driven by interest rates being low, and also the recovery that we've seen, and finally, earnings being kind of impacted near term. There is a theory that, as I've said before, stock prices are really priced against longer-term earnings. But anyway, by these traditional measures, the U.S. markets are pretty richly valued. But when we look outside the U.S., EFA is, reasonably valued, I'd say, and then emerging markets even are a little richly valued. But again, I think the spirit of it is to say that, this is a function in the end of longer-term earnings and interest rates, actually. So the pattern we like to look at, just updating this as it relates to the volatility in the equity market, this happens to be the world equity market, as it experienced different outbreaks of the past. We know, as we've talked about before, that this last one triggered a lot more volatility than normal, but the good news is that we're seeing recovery. And so again, lots of volatility around coronavirus, all for good reason in terms of the shutdown of economies, but the good news is some recovery. We're also reminded that this pattern of return is common over history. This is the bull-bear chart, just reminding us that markets tend to have extended sort of expansions followed by a shorter bear market, a little bit of contraction. We're in a very quick sort of bear market, and again, looking like we're in recovery. So again, there's a decent chance as we go through time that this window and sort of decline, this bear market we're in, is going to be this very sort of narrow, quick move. But again, time will tell. We'll see how that all unfolds. Here's the chart we like to show that shows the movements of the S&P 500, in history in terms of significant moves down, and then the recovery. And remind everyone that the green bars are these are all 12-month returns on the right. The green bars indicate full recovery, or we've labeled it in terms of how long it did take. What's interesting is after being down almost 34%. With this latest move, we're up a little over 44% as of this recording, and really reasonably close, within a single-digit percentage points, 4 or 5%, to all-time highs, to basically making up the recovery. And obviously, that's just after a couple of months or so. So again, we're going to watch it, but what we're sort of seeing happen is what's happened in the past. Moves down in the market are followed by recovery. So this is a chart we always like to show that's super busy. We never go through it in any detail, but it's really to give you a sense for all the things we're tracking. And as I looked at this and prepared for this month's video, what I was struck by was all these different categories. So U.S. and global economy, central bank policy, geopolitics, markets, of course, headwinds and tailwinds and themes. All of them have been significantly influenced by the virus and the crisis related to that. Clearly, as it relates to, things like geopolitics and protectionism, which is one of our themes. Essentially, with this happening, people have been sort of spooked by their global partnerships and global supply chains, for example. So people just incrementally are looking more inward. They're looking to become more inwardly focused and sort of self-dependent. That's a form of protectionism. Another interesting theme that's been impacted, we sort of couched in the fourth industrial revolution, which is all about technology. And basically what we know is that technology has been a real savior in this situation. As it relates to how we communicate, as it relates to how we order services, and sometimes have goods delivered, as it relates to the way we communicate in terms of business meetings. Everything's being done with technology, and so essentially this crisis has basically accelerated the implementation of a lot of those ideas, and really that overarching theme of a fourth industrial revolution anchored in technology. So we do like to monitor sort of the impact of the virus, and this chart is one of 2 pages that we call the coronavirus dashboard. So again, things that we're monitoring, as we've discussed before, is the impact on jobs and the economy. We all know that we've been in a recession, and that we're looking to sort of a down 5 to 6% in GDP this year, both in the U.S. and globally. We're seeing confidence from the consumer recover, but being impacted a little bit by the slowdown and reversals of some of the reopening plans. And then we're seeing those purchasing managers indexes, so basically that survey data, recovering well. So businesses are optimistic about the near-term future. The second page basically profiles much the virus, and I think the bottom line is what we know is this virus is a tough one. You have to be super careful with the reopening, trying to maintain social distancing, wearing of masks, good hygiene, all that, and where that isn't happening, people just maybe bursting out and starting to socialize and kind of come back. We'll see these sort of hotspots in the virus. So we're going to keep monitoring all that. And it does influence our views. Now, on the support side, we all know that there's been record support from the Fed around monetary policy and related matters, and then record support from a fiscal policy perspective, which is basically legislation to help put money back into the hands of people, to support businesses with low-cost or forgivable loans. And, basically, there's been just a ton of support. But what we're monitoring, and we're going to write about this week in our Sightlines publication, is basically the pending legislation. So there's a House bill out there. I think it's a total of $3 trillion in support There's a Senate bill out there that I think focuses a little more on infrastructure, and it's much smaller. And then you have the administration basically talking about payroll tax cuts and some other things. And so the way our system works, especially in a split government, is that these three parties ultimately are going to have to negotiate, come together, and work together to get new legislation passed. And there's sort of a collective goal to try to get this done this summer. It's not clear that they will, but that's going to be in focus in the next few weeks for sure. As it relates to monetary policy, here's a quick snapshot of rates and spreads. The upper left just shows the Fed funds rate and how it kind of climbed a little bit, and then with this need to cut rates to almost zero, that moved dramatically down, and it's just staying there. And the Fed's signaling that it's basically going to be there at least until 2022. Correspondingly, on the right side of the upper part of this chart, the Treasury rates all came down, so rates are low. And then while spreads widened out for high yield and corporate bonds, they've come back in. And so long story short, we're in an environment where for a borrower, rates are pretty low. So that's good. It helps people with their businesses or their personal circumstances. But then from an investment perspective, rates are pretty low. And so, it makes us sort of think about how we're going to invest, where we're going to invest. In fact, here's an interesting chart that we think is super important to look at. Look at it as the excess yield you get in total if you buy stocks, in this case the S&P 500, versus what you get buying the 10-year Treasury bond. And so normally, hey, maybe these two things are near each other, or you would sort of expect from a yield perspective maybe for bonds to do a little better. But the bottom line is, in this environment, you're getting a lot more sort of earnings return, including dividends, than you do from a 10-year Treasury. And so there's definitely an argument for making sure to have a decent exposure to equities from this perspective, even when it comes to just looking at cash flow. Now here we're reminded on this next chart, the sort of the pattern of GDP. Again, we're in this period where we're going to see some decline, but that right chart just reminds us that the consumer consumption is a critical part of GDP. So we're super focused on how the consumer's feeling. And in fact, this next chart just reminds us of the story that's unfolding as it relates to unemployment. So basically, the latest unemployment rate as of the end of June is 11.1%. It's down a bit from sort of a recent high. And then you can see that continuing jobless claims number, almost 17.4 million. Most recent weekly jobless claims, 1.3. And then yet jobs starting to be added back, this ADP number at just under 2.4 million. And so it's this intense pattern, people losing their jobs, sometimes temporarily, filing for unemployment, but then jobs coming back as the things reopen. So all of this is something that we're watching very carefully in terms of the function of the economy, but also kind of the mindset and sort of health of the consumer as it relates to that. On the business side, here's a bankruptcy index from Bloomberg that we just track, and basically it's a signal of how things are going on the corporate side. And again, what we're seeing is a bit of a tick up in bankruptcy activity, not surprising given everything that we're going through, but again, something we're monitoring. Still sticking to the business side, here's basically a chart showing the S&P 500 companies that have cut or suspended their dividends. And so again, you go back to the financial crisis, there was a lot of that going on. Then it sort of calmed down up until this situation where, again, it's still, only halfway through the year, and we're seeing a number of companies that have cut or suspended. So it's something that we're going to watch very carefully, in part because on this next page we see that we're reminded specifically to the right side that dividends are an important part of a stock's total return. And in fact, many of the companies are also suspending buybacks. That's also an important part of a stock's return. So those actions by their nature are going to mute the returns potentially. And again, so it's something that we're monitoring very closely. Now, finally, as it relates to, we talked about sort of that mobility and sort of social distancing and things slowing down. It's really about kind of making sure people aren't in close contact with each other. And as we've discussed before, that's impacted a ton of different industries, travel, restaurants, et cetera. And so the net result of all that is we know earnings are going to be down, for example, as it relates to industries like that. And so as we're tracking earnings, and here on page 30, what we're seeing is that while we had an optimistic outlook and the industry had an optimistic outlook at the beginning of the year, these blue bars in the upper right are the latest sort of consensus forecast for earnings growth, which in this case is negative, each quarter in the year 2020. And the good news is, while we expect a big hit, we're in earnings season right now for second quarter. We're learning about how things are going in terms of earnings impact. What we do expect to see with the economy reopening, et cetera, is for things to come back in the second half, and this chart shows you that. It all rolls up to the economy. So again, I mentioned a moment ago that we're seeing, significant decline expectation for 2020, but this tells us and kind of reminds us of the pattern that's expected. So we're down about 5% in the first quarter. And these are annualized numbers. What's expected in the second quarter is a significant decline. And again, that data is going to unfold here relatively soon. And then the third quarter, there's an expectation with the reopening, et cetera, of things to rebound pretty handsomely. So again, the way to think about it is that, as it relates to market levels and so forth, this is what's expected. People expect this negative hit and then some recovery. So we're going to all be sort of monitoring that very carefully to see whether the reality sort of plays to this forecast. Because if it's better, maybe markets are supported a little more, and if it's not better, if it's worse, maybe that provides some downside pressure on equities, for example. As it relates to the pattern of the recovery, we've talked a lot about this chart and really focus on the right side. Basically, people are watching for a V-shaped recovery. There are some data points where that's happening, but a lot of data where it's not quite that clean, that basically we had the significant decline and then it's been sort of choppy and slow sometimes in terms of recovery. So again, something that we're going to monitor, and for all we know, there will be a new letter identified to describe the shape of this recovery sometime in the future. All right, turning to the election. So in the past, we've, I think, shown just prediction metrics on this chart. We've sort of opened it up to three sources, and they all tell the same story. So we have on this page basically polling related results, predictions. So think of it as betting markets related results. And then interestingly, one provider that we subscribe to has a portfolio designed to do better. One portfolio to do better if Republicans look to be coming strong, and another portfolio to see how that will unfold well if Democrats look to be doing well. And then this is the ratio. And basically the story across this chart is that right now, Democrats look to be in a good position. So Biden looks like he's setting up to win this election if this data plays out. And then there's also talk about sort of the Congress and where that's going to go. But a couple of things that I think are super interesting about this analysis that we've been doing. The first is to watch the market right before an election. Basically, the pattern has been in the past, if for the 3 months leading into the election, you see a strong equity market, usually you have the incumbent reelected. So I think the spirit of it is, people are recognizing there isn't going to be a change, and people sort of react to that and markets go up. The other thing that's super interesting is the studies for sure show that when the government is divided, so no one party has both houses of Congress and the presidency, if it's divided, then markets do better. So that's something, of course, that we're going to be watching very carefully. Now, this is a super busy chart. It's almost like a probability class chart where we're looking at all the different combinations that could occur as a result of the upcoming November election. And you could have a single party sweep, Democrat or Republican. Right now, the probabilities are about 57% of a chance of a Democratic sweep, and that's, again, betting odds. But you can see all kinds of different combinations. And, another one that is in keen focus, of course, is the current situation. And so, again, we'll watch all this unfold. But I think finally, I'd say it relates to obviously policy implications. So if there, especially as a sweep by the Democrats, we should expect higher taxes. We should expect more regulation. And we'll be analyzing what we think about all that in terms of the impact on the GDP and the markets. So as it relates to our outlooks overall, we've, through the year, had three scenarios that we've talked a lot about: a base case, a bull case, and a bear case. All three are now driven by the coronavirus and the reopening. But what we've recently started to focus on is the tails, so those last two, the bull and the bear. And I think importantly, the idea that 20% chance is a little bit high relative to what you would normally expect in terms of the strong up move in the market or a strong down move. So we started talking about the fatness of the two tails, and it's actually influencing our investment guidance. So, we did a sightlines on this on July 10th, and basically the spirit of this is to say, look, we see these two tails unfolding in the following way. Excuse me. If it's a bear event, what that really relates to is probably a combination of the reopening going poorly, and we'd say it's rough right now, but not super poor, but also maybe some missteps or some signals that the medical innovation isn't working. So there's definitely downside risk out there. But on the flip side, the bull case could unfold, especially with either stronger therapeutics or, most importantly, a vaccine that's known to be effective. And so, you can almost see we're in this environment where we could move in either direction. And so, basically it sort of begs the question, what to do about that. Now, the other thing I'll mention is just to sort of close out on the sightlines of late, we basically also published, I call it other forces at work. So these are factors that we were really focused on at the beginning. We've talked about the election, but Brexit's still open and they're needing to negotiate a trade deal. The idea of deglobalization has presented itself, that idea of countries becoming more inwardly focused and more self-dependent. And then obviously the policy effects of everything that's going on. And so these are all things that are in focus. It informs those three scenarios. And then ultimately, this quarter, we're making a shift in some of our dynamic leanings that relate to all this. And so let me walk you briefly through this. The way to think about it is, as we entered the crisis, we quickly shifted things to be, in a certain way, a little bit defensive. And so we went overweight large cap stocks in the U.S. We went a little bit overweight U.S. stocks. And we essentially went overweight large company growth stocks, which included those stocks that performed well, those bigger tech companies. And the spirit was, hey, we think these companies are going to do okay, even with sort of physical shutdowns of businesses, et cetera. And in some ways, that's all played out here on the equity side. But we're essentially, because of that, the signals we're seeing in terms of medical innovation, we want to move more in a direction of taking on a little more risk that, by the framework we have, is basically moving us back to neutral. And so this is very unusual, but we're basically, across all the dimensions that we think about, we're going to neutral, specifically because we can't tell whether we're going to see that bear move or the bull move. And so essentially we're going to be neutral and wait it out. And I would also say, when we do make a change next, it could happen very quickly, because what we expect is these tails will signal themselves relatively quickly. Now, on the fixed income side, for example, we were a little bit overweight higher quality corporate bonds in the taxable space. And that's one of the dimensions that we had. We were overweight TIPS. And then a little bit short duration, same thing. We're coming back to neutral. Could be for a short time, but as we wait out and sort of analyze the likelihood of one of those tail events happening. So again, more to come on that in future episodes. Hey, we're going to end where we always do, which this chart sort of lays out the body of work that we make available to our clients, and it really is anchored in the calendar. So daily content that comes out weekly, things like this on a monthly basis, and then some quarterly and annual content. We welcome your review of any or all of it. So thanks so much for joining this month, and we'll talk to you next month.